Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. Now, U.S. equity momentum is extremely positive to end the second quarter of 2024. Let's take a look at where that 6-month return looks relative to history. Now, a lot of talk about the Fed, and rightfully so. Obviously, they're still pausing, but we are starting to see expectations change from 3 rate cuts in 2024 toward potentially only 2 rate cuts. Let's unpack some of the reasons why. And finally, U.S. labor market and leading economic indicators continue to surge as the economy continues to beat expectations as 2024 unfolds. Now, on the chart here, we have various equity indexes from the S&P 500 Large Cap Equity Index, S&P 400 Mid Cap Index, the Russell 2000, that's small cap equities. And then you have international, EFI, and emerging markets, along with that value and growth segments of the market. In the teal color, we have the 6-month percent change. So the percentage that these various equity market indexes are up during the past 6 months at the end of last quarter. In the dark blue, we have the 20-year average. So why is that important? Take a look at the dramatic difference. You can see the S&P 500 large cap index is up 23% versus 6% for the 20-year average. If you look across the various different equity indexes, one thing is very clear. Equity indexes are generating gains through the first quarter over the past 6 months, 3 to 4 times their 20-year averages. Some sort of a pullback is not going to be a surprise here, folks. This type of momentum is not normal, and we're really fortunate in terms of the gains that we've had during the past 6 months. Now, let's unpack the Federal Reserve. March 20th, they had their Fed meeting. Well, let's take a look back at the expectations of the stock market. On the table here, we have the number of rate cuts by the end of 2024 with a few different dates listed: December 2023, March 2024, and April 2024. What are these dates? These dates are the start of this year, the last Fed meeting, post-Fed meeting, and then recently on April 10th. Okay. As you look at the expectations at the start of the year, the market expected 6 or more rate cuts. In fact, 82% probability based off federal funds futures contracts. So real money transactions from participants in the market were enabling us to develop these probabilities. And you can see 82% probability of the Fed cutting rates more than 6 times. Fast forward to March. The Fed, we had, remember, January and February, inflation it didn't skyrocket, but the pace of the decline in inflation slowed. Okay. And pockets of inflation, perhaps wage growth and some of those, were proving a little bit sticky. And we saw economic data be very resilient, which we're going to talk more of in just a second. So in March, post-Fed meeting, you see the probabilities drop to only a 1% chance of that 6% cut. So 3 rate cuts have been pretty much base case during the past couple months. But post-Fed meeting, we've seen comments from Jerome Powell. We've had several comments, most notably Kashkari from Minneapolis came out and talked about he was one of the committee members who believed there was only going to be 2 at the Fed committee meeting, but he said if inflation doesn't significantly improve, they might not cut at all. There were other various Fed governors, committee members that came out and echoed some similar narrative. Also, take a look at that April 2024. So since the Fed meeting, we've seen expectations for the first time drop to 49% for that 3 rate cuts. And you can see that 2 or less up to 51%. So perhaps about a coin flip, but for the first time, we're seeing those expectations shift slightly to only 2 rate cuts by the end of the year. Now, why is this happening? Well, let's take a look at a couple data points. The labor market was impressive in March. 303,000 new jobs for the month of March relative to February. That is 103,000 jobs more than the expectations, the consensus estimate. That's incredible. That's a really strong number from a labor market perspective. The US unemployment rate also dropped back down to 3.8%. This has been more than 2 years now that the unemployment rate remains below that 4% level. That labor market, this labor market in the United States has been very resilient. Now, the Conference Board has a leading economic index, often referred to as LEI. This is a combination of various leading economic indicators from wage growth, credit indexes, the stock market, risk indexes, other macroeconomic related to manufacturing surveys. Why is this important? It increased by 0.1 points in February. That was the first monthly gain in this index since February of 2022. So more than 2 years. The Conference Board predicts, if you read their notes, that they don't believe there's going to be a recession, but they're predicting an economic slowdown in the second quarter and the third quarter of 2024. So labor market strong, leading economic indicators showing very strong numbers relative to recent history. This is giving the Fed permission to not be as aggressive on rate cuts right now. And that is why we are seeing expectations move from 3 cuts down to potentially 2. And right now, it's a coin flip. So let's wrap it up with some good news in terms of a new world record Guinness Book. A London gentleman is now the world's oldest man. He is 111 years old. What a run. He credits his longevity to luck, moderation, right? Not eating too much of anything, not drinking too much, but drinking a little bit. No smoking, but get this, weekly basis, fish and chips. So obviously that's a bit of a London tradition, but that combination has worked for him. So congratulations to you, new world record current holder here, 111 years. So congratulations, and I wish you many, many more wonderful years. So with that, I want to thank everyone for watching, and I'll see you next time.